So welcome back to the Rogue Trader podcast with me, Nick Leeson. I'm joined today by market expert Jason Sen. So we're going to have some fun talking about various things that have happened in the markets over the last couple of weeks. What Jason sees from the charts going forward, because I know that I need those at the moment. I've been whipped around by gold, certainly over the last number of days. It's had some very aggressive movements, but we'll talk about those. The big news, I suppose, in the world of finance today is that Tom Hayes was at the Supreme Court to hear the verdict on his appeal against his case. So his conviction has now been squashed. So he went to jail for a total of 5.5 years. The sentence was 11 years. He's still been on license up until just recently. The original sentence was 14 years. So it's probably, one of the biggest sentences that have been seen in the world of finance over the last 10 to 15 years, possibly ever, to be honest with you. It's certainly a lot bigger than the sentence that I faced in Singapore. And Tom's been fighting that injustice since the first time that he was interviewed by the Serious Fraud Office. And so I'm sure there's going to be ramifications now for the Serious Fraud Office going forward, for his previous employees, for his previous employers in the form of UBS and Citibank. And also, I would imagine that there's going to be a number of people that have perjured themselves at those first trials. So it's going to be really interesting how this evolves over the next period. But because Jason's here, it's all about Libor rate rigging, or that's the moniker that it's been referred to over all of these years. Jason, you were very active in the short sterling pit all those years ago. So, perhaps you'll give us an explanation first off about how Libor affects the short sterling pit in terms of the settlement or whatever, and then maybe your views or your opinion about what was going on at that particular time, and I'll relate that back to some of my own experiences as well.
Yeah, sure. Okay, so in the 90s, I was a market maker on the London International Financial Futures Exchange, and options market maker in the short sterling pit, which is 3-month interest rates, Libor. So we would trade 3-month expiries, March, June, Sep, December, and basically Libor would then settle to what the options and the futures would settle to whatever the Libor rate was on expiry. So we'd have 4 expiries a year. Now, we as market makers knew that the system was rigged. I mean, when I say rigged, I didn't think it was illegal. I thought it was just standard practice because the Bank of England would go out into the market to, I don't know, was it 7 or 8 investment banks and ask them for their 3-month Libor rate. And obviously, all the investment banks had positions, and of course, a very tiny fraction move in the Libor rate or the settlement would affect their P&L. And I'm sure you're talking about tens or maybe hundreds of millions or even billions for these investment banks. I don't know. I didn't work there. But anyway, us as small market makers on the floor, it was accepted that 3 or 4 days before one of these expiries, you flattened out your position because there was absolutely no way of knowing where the settlement would be. Now, the futures might expire here, but the Libor rate might be somewhere out, and there was no way you could hedge that because the market expired. So you absolutely did not have any expiry risk. So as I say, that was just standard practice. I thought that's the way the system worked. So when I discovered that the Bank of England or the SFA, the Serious Fraud Office or whatever, was saying the system's rigged, these guys are criminals, I was really shocked. That was probably 10 years after. It was over the global financial crisis, wasn't it, when this all came to light? So, I mean, I was aware of this system for 15 years before that. The whole city was. I mean, everybody knew. And of course, if I was working at an investment bank and I was responsible for that book, I'm not going to mark it against me. I'm going to on the trading floor every single night. We marked our positions to market, and I would fight for the various strikes to be marked in my favor, because otherwise I could be losing 5 or 6 figure sum overnight. So anyway, that's my take on it, and I was really shocked when criminals proceedings were started, and I felt very sorry for Tom.
Yeah, I think I met Tom a couple of weeks ago, and he was obviously very, he was very positive about the outcome. there's a bit of a legal technicality over which the ruling was today in terms of the way that the judge directed the jury to look at what happened. So that's the thing that's really led to the overruling. But it's one of those things, and like I've probably mentioned this before, but when I think of my time in the investment banks, part of the ethos, really, if you like, was how are we going to take the situation that we're in at the moment, be that a settlement situation, an IT sort of question, or a trading question, and look to gain some edge. And there were ways, certainly, during my time at Barings, where trades were booked to Singapore that would be initiated in London, but because they were equity transactions, there would also be a foreign exchange part of that when it came to the settlement. So, you've got 4 or 5 hours in Singapore where the exchange rate's going to fluctuate. They trade at a certain level, but because they're booking offshore, they probably give that level less or plus a little bit to make sure that they've got, they're taking a bit of money out of it as well. And I know the guy who did this, and I would regularly, I'd regularly meet him for a drink and stuff like that, and he would brag about how he was making this £2 million a year risk-free, because it is risk-free. He's given a different price to his client than he's actually getting in the market in Singapore. But because, again, because of that fluctuation, he's able to do that, and the timing difference. I'm sure after all these years, because of the added transparency we see in the markets, you can't do that anymore. Everything is time-stamped, and you can watch that back through. But at the time, and I suppose this is where I was going with this particular story, if you allow directly, indirectly, an area that can be manipulated. I know manipulated is a strong word, but where you can work within certain levels, or within certain time constraints that exist within the market, it's far too easy to abuse. And I think the example you're giving is that everybody knew about it, and there are various other things that where that's been shown as well. I was looking at a story this week about a certain amount of front running. When does it become front running? Because if you've got a big order coming through from a client and it's 150 million or it's billions worth of dollars in a currency market, all of those years ago, you would make sure that you start to accumulate some of that position early so that you can pass it on to your client.
Or it might even just give you a warning not to be on the other side of it, and you might flatten out. There's all sorts of ways that information.
Yeah, exactly. And when you're not, when you haven't worked in the markets, you see some. I think, when you look back at Tom's story, and I know he describes it himself, it was a bit of a morality issue, right? Not necessarily from his perspective, but again, you mentioned it when you were talking about it. It was 2008, 2009, 10, around that sort of period. And bankers were worse than the shit on your shoe during that period, because you've got the global financial collapse, and people are looking for a victim and somebody to blame. And for a period of that, I think Tom was probably that person, and the other co-defendants, because we found something that's not completely correct. But like you said, somebody to blame. And I think when you look at, I don't know when Libor started, you may have the answer to that question, but I would imagine that's been manipulated from the day it started, because you were able to.
Exactly. And I think your point is that he was not acting alone. There's no way that everyone else in the department and throughout the bank didn't know that was going on. I mean, if I knew, everybody knew.
Yeah, and it gets passed down. He sat at a desk somewhere in London or Japan where he was for a period of time, and the guy next to him, who's a little bit senior, he is telling him, this is what you do. That's how it was passed. That's how it was passed down.
If you didn't do it, you'd have been in trouble, because you'd have cost the bank money. Your superior would come and say, what the hell are you doing? Why did you not move that in our favor? It's cost us X amount of, whatever. It's crazy. This is ridiculous.
So he ended up with a 14-year sentence. He did 5.5 years in prison. Yes, he got the sentence reduced down to 11. He still can't leave the UK, probably until today, because he's been on license all throughout that time. It ruined his marriage, got divorced. didn't, I think one of the stories that I read this morning or when I was speaking to him last week or the week before, his son came to see him in the court, and he still expected to get acquitted at that point because he didn't see that he'd done anything wrong or, I suppose it's a phrase that somebody used years ago when I was listening to them about something that was going on within in an organisation, an acceptable band of dishonesty, if you like, almost, because the way that the Libor rate setting had been approached by all of the regulators over the years just allowed that to happen, unfortunately, and Tom was the guy that paid the price for that. But I'm sure there's going to be a lot of people who are paying an even bigger price now to in restitution for what's been a terrible period of his life. And just going back to that earlier story, his son was 3 years old when he was sentenced, and he expected to go home that evening and see his son. And he's carried off and he's going to Belmarsh, wherever he ended up. He didn't necessarily. He certainly didn't do any easy time, but I'm sure we'll see a lot more about it over the next few days. But I think it's great to hear from somebody who was in the short sterling pit at the time, and understands exactly what was going on, and here, that everybody knew about what was going on at the time. Bed and breakfast trades, all these sort of things that used to happen during that period. Option expiry is still a bit of a quagmire. You might be looking at the Dow or the S&P 500 on the last day of the month or the last day of the quarter, and some of the moves are just astronomical, and they come out of nowhere, and it's all option expiry related usually, and people are trying to get out of that way. But it's great that he's got the decision that he did today, but doesn't excuse anybody for what went on before. I think David Davis was there today because I saw some of the court proceedings and what went on afterwards, and he just he described it as a miscarriage of justice upon a miscarriage of justice upon a miscarriage of justice. And I remember years ago, I met a guy called Danny Williamson, who was one of the guys who was acquitted early on, but it ruined his life. It ruined his family's life, and it's just that personal impact of it is just something that can't
never get that time back. No, I'll look forward to the podcast when you interview Tom.
Yeah, I'm sure. Well, it might be Seth who's doing that interview because Seth is very close to him. But we'll see. It should be. Yeah, no, you're more than welcome to come on that one because you've got some directly related stories. So if we move on, a little bit with markets, last Wednesday, so it's Wednesday today, President Trump was announcing that he was going to sack Jerome Powell, which we all know that he can't do, but the markets don't react in that way. You get that fear and you get that panic. And I remember looking at gold, and it was trading, around 33.30, spiked up to 60, 70, 75. I was a little bit short during this period, but I'm not sure if I managed to hold it or I had no choice but to hold it. And then eventually it came all the way back down to 30 before it started to move again. But since that point, and like I see a lot of your recommendations and your analysis coming through, Jason, you've expected gold to start to trend higher again from that point. It's done that repeatedly, even just most recently around 33.90. I think you expected a break to the upside. We certainly saw that. We're up around the 34.28, 34.30 level at the moment. But maybe your views on gold and where's it going? Because if nobody else needs to know, I need to know.
Okay, well, we've got just a very classic triangle pattern which has formed since April. As you can see, the high of the pattern on the upper trend line is in April and the low is in May, and then we just had this narrowing price action as we headed towards the apex. Obviously, it has to break somewhere. I had that little trend line in here which had just joined the previous peaks. I was looking for an initial break above there to indicate that we might start to see some movement at last. I mean, this whole consolidation, I hate this. I really can't trade these markets when they're up for a day or two, down for a day or two. So I needed this to happen. We did jump into a long position, and typical technical analysis, we retested the trend line. Nice little buy opportunity there yesterday. The low for the day, bang on the trend line. The break above the upper trend line of the 3-month pattern, and now we're ready to go. I think a triangle is a consolidation pattern, a continuation pattern, which means that the market is more likely to continue the previous prevailing trend, which of course is bullish for gold. We all know that's been soaring in recent years. So for me, this looks like a bullish confirmation. Again, you can see today that we are lower on the day, but we are holding that trend line now as a support level, as indeed we should do. So as long as we close above that support level, I will be feeling pretty bullish about gold going forward. If we don't, then we're going to have to see what happens if we drop and retest that smaller trend line down there.
Okay. All right, then the other markets. So one that I was looking at this morning was the S&P 500. I know you've done some analysis about that as well, and have been pretty much spot on over the last couple of weeks with the trend that we've been seeing. I think the S&P closed at another record high yesterday. There was a bit of research coming out from Goldman, so I think we're around where are we, 6309, somewhere like that, in the cash. So I think there was some research coming out from Goldman's that was looking for the markets to test 6,600 possibly by the end of the year, 6,900. So very much from their perspective, this bullish trend is definitely intact. One of the things that they were concerned about is that the rally is quite narrow, in that it's very AI and tech related stocks that are included in the S&P 500. But you know, whilst they're worried about that, a broadening out into the other sectors of the S&P 500 is, in their opinion, going to see it higher. So I just wondered what you thought there with the S&P 500.
Yeah. Okay, Nick. Well, as you can see, this is the 4-hour chart, but the E-mini S&P futures, that's the one that I trade. So I haven't got the cash up, but it's all pretty much the same. This is a difficult consolidation pattern, but again, it's a consolidation pattern. It's not a reversal pattern. Consolidation pattern means that the market's pausing, and of course, it's normal. You can see back here around end of May, beginning of June, we had a consolidation pattern not dissimilar to where we are now. Eventually, you break up, you consolidate again. So we keep making slightly higher highs, which is why we've got a slightly upward sloping trend line on the top and on the bottom. And yeah, you could maybe even call this a flag pattern. Certainly it's a sideways channel. For me, I think we will break up eventually. I think probably and I'm only guessing, but I think we probably need to test this lower trend line at least one more time before we break higher. I think the market's a bit tired. I think it's running out of steam. I think it's overbought. Probably need to shake out some longs before we go again. But in the longer term, yeah, I do see this breaking up, maybe after a very small short-term correction.
Yeah, well, I think you've got Alphabet and Tesla results coming out after the bell today, so, and then you've probably got 4 or 5 days of the mega tech earnings. So if they don't show any real sign of the tariffs damaging their earnings, I don't know. Like you say, consolidation and then maybe a bit of an upward or upside pattern returning to that market. We started talking about Tom Hayes and about possible manipulation, and I'll go back to one that we spoke about probably a few months ago now, probably around the inauguration of Donald Trump when he introduced the Trump coin. But Bitcoin has hit new highs over the last week to 10 days. I think we traded up to about 124,000. It's pulled back, and again, as you've spoken about when you're looking at the last two markets, there's been that period of consolidation, and we're probably in one at the moment. Although I don't want to prejudge what you want to say, but just on the manipulation side of it, I think the big piece of news in relation to the cryptos was, and I was looking at Donald Trump's Trump coin this morning on this basis, but one of the acts that he's trying to get through in Congress at the moment is allowing pension fund money, the 401k in the US, to invest it in cryptocurrency. So there's a big question, and a lot of people have said, that will see cryptocurrency double over the next period. I'm not so sure about that. I think, yes, it makes things more accessible from a crypto perspective and investment perspective, but I don't see people necessarily going out and buying a load of crypto to make those investments. So it might be overshot on that perspective, but we'll have to wait and see. But what do you see chart-wise for Bitcoin?
Well, again, it's down to a pattern. We've got a descending triangle, and we've broken to the upside on that, which is not a major surprise. Of course, Bitcoin's been in such a strong bull trend for so long, I don't even need to show you the daily chart. So this is what's key for me over about the last 5 weeks. Again, very difficult sideways consolidation pattern for day traders, but we've broken up, and now we're retesting the break point. I would be surprised if we get back into the triangle. It would be disappointing for Bitcoin bulls for sure. This might just be a golden opportunity for short-term traders to jump into Bitcoin right now, actually, as we retest the break point, and maybe then we'll start to surge. If I'm wrong and we start sinking back into the triangle, then of course we've got to make sure we hold above the sort of 116,500 area. We start breaking below 116,000. It's going to be a little bit negative in the short term.
Okay. All right. Just before we go, pleasure as always, Jason, to speak to you. Have you still got that 100 Bitcoin that I gave you back in 1995?
No, I lost it. Sorry.
That was just before I went away, I think. But anyway.
If only, mate. If only.
For anybody listening, thinking that may be a real story, that was a lie, right? I promise you, it was a lie on both of our.
I'll be getting a call from Interpol.
Yeah. All right. Well, look. Thank you very much, Jason. Please, if you like what we do, please subscribe, like, and share access to the podcast, and we'll be back very soon doing some other stuff as we see that in the market. Thank you very much, Jason.